Welcome to the Deep Dive, your shortcut to really getting up to speed on the most important earnings calls. Today, we're taking a proper look into Swedbank's second quarter results for 2025.
That's right. We're going to unpack the key financials for you, get into what management's thinking about the economy.
And try to connect those dots, figure out what it all means for the wider banking scene in the Nordics and Baltics. Let's jump in.
Okay, so Swedbank had a really strong Q2. I mean, they showed they can generate value for customers, for shareholders, even with all this global uncertainty kicking around.
Yeah, the numbers look solid. Return on equity was what, 15.4%?
Exactly. And earnings per share hit 6 krona and 99 öre. Pretty good.
And the thing that jumped out at me straight away was that cost to income ratio, holding steady at 0.36.
That definitely signals some tight cost control.
It does. Although we did see net interest income, the core earnings from loans versus deposits that actually dipped a bit this quarter.
Right. And net commission income, NCI, that was also down.
Why was that mainly? Stock market performance?
Yeah, mostly lower average stock market levels early in the quarter hitting asset management fees. Although card commissions gave it a bit of a seasonal lift, which helped.
Okay, and costs. You mentioned control there.
Yep, costs stayed flat compared to Q1, and credit quality looks really solid too. Credit impairments were only 150 million krona. Very manageable.
And that ties into their capital position, doesn't it? Still looks incredibly strong.
Absolutely. CET1 ratio is sitting at 19.7%.
That's that core measure of financial strength, right?
Exactly. And it gives them a pretty hefty buffer, 4.5 percentage points above what's required. Plus, strong liquidity. It's a comfortable place to be.
So let's dig into that net interest income dip a bit more. You said 572 million krona down.
That's the number. And it was mostly driven by falling interest rates, the policy rates, and also a negative hit from their central bank placements.
But they managed to offset some of that.
They did, yeah. Partly by lowering the rates they pay on customer deposits. So that helped cushion the blow from lower rates on their customer loans.
It really sounds like a timing game.
It absolutely is. Management explained it quite well. The Swedish loan book, that takes about 3 months to reprice generally.
Okay.
But the Baltic loan book takes longer, more like 6 months. But, and here's the interesting bit, the liability side, their deposits, that reprices much faster.
So they feel the benefit of lower funding costs from rate cuts sooner.
Sooner than they feel the full negative impact on their loan book.
Exactly. But even with that dynamic, lending volumes still helped.
Yeah, increased lending volumes actually added about 150 million krona to NII this quarter. So growth is still contributing positively there.
And the plan is just to keep balancing that act. Pricing, volumes, long-term profit.
That's the message. Keep a disciplined pricing strategy on both sides of the balance sheet. It's definitely a balancing act.
Okay, let's look at that volume growth then. Loans and deposits. The total loan book grew by, 21 billion krona.
Yeah, significant growth. Mortgages in Sweden, just through their own channels, were up 3.5 billion krona.
Which is pretty good considering the Swedish market's been a bit slow overall, right?
Exactly. But interestingly, in the Baltics, mortgage demand is actually picking up because rates are lower there now.
And corporates.
Strong growth there too. Swedish corporate lending jumped by 11 billion krona. They're clearly focusing more on the corporate side.
Seeing activity in specific sectors.
Yeah, they mentioned real estate, manufacturing, and good growth with SMEs, small and medium enterprises across Estonia, Latvia, and Lithuania.
And Baltic lending also grew.
It did. Corporate lending up 4 billion krona in the Baltics, and private lending, mostly mortgages again, also up 4 billion. So broad-based growth, really.
What about the other side? Deposits.
Deposits climbed too by 27 billion krona. Mostly retail deposits in Sweden, partly seasonal, tax returns coming in.
Okay.
Corporate deposits in Sweden were up 2 billion. Baltic private deposits up 7 billion, although Baltic corporate deposits dipped slightly, down 1 billion.
Now, you mentioned mortgages. Swedbank's always been strong there, but they made a move this quarter, didn't they? The Stabelo acquisition.
Yes, that's a really interesting strategic development. Stabelo is a fully digital mortgage company.
Aimed at younger customers, I guess. More digital focus.
Precisely. They want to develop the mortgage business and reach that younger, more digitally savvy crowd. And crucially, Stabelo will keep its own brand and management.
Suggests they wanted to stay agile, maybe try new things.
That's how it looks, yeah. A distinct approach within the group.
Okay, shifting gears slightly. Non-interest income. We touched on NCI being down.
Right, the commission income. Mainly because asset management fees took a hit from the stock market early in the quarter. Swedbank actually has a higher chunk of equities in its fund mix compared to some rivals.
So they're more sensitive to those market swings.
Yeah, both on the way up and the way down. But on the flip side, net gains and losses, NGL, were strong. 856 million krona.
What drove that?
High business activity, apparently. Fixed income, FX products, and also some positive revaluations on small stakes they hold in listed companies. So there's some good underlying activity there, too.
Let's talk costs again. Flat overall at 6.1 billion krona, which is impressive given inflation.
Very impressive. Staff costs actually went down, fewer employees. That offset rises in IT and consultancy spend.
And then there were those VAT recoveries. That seemed quite significant.
Huge. It's not just a one-off. They got back 174 million for 2018 this quarter, after getting 205 million for 2017 last quarter.
And more potentially coming.
Yes, they were told about another 197 million for 2016 just after the quarter ended, and they've put in claims for 2019 right through to 2023 as well.
Wow. That's quite a tailwind. Shows real focus on operational details.
Definitely. And it directly impacts their outlook. The full year cost guidance, originally 26.5 billion, is now expected to be about 1 billion krona lower.
Primarily because of these VAT wins.
Mostly VAT, yeah. Plus some favorable FX effects from a stronger krona, and also because some temporary investments were front-loaded into this year, meaning less spend next year. They'll update the guidance officially in Q3.
And they're still keeping a tight rein on spending generally, even though the hiring freeze is over?
Oh, yeah. Strict cost control is still the mantra. Efficiency drives, cost sharing on IT with savings banks, all that continues.
Okay. Credit quality sounds like no major worries there.
No, remains solid. Strict lending standards, good collateral backing it up. Risk-weighted assets, the RWAs, did increase by 12 billion krona.
Mostly due to that loan growth and FX effects.
Exactly. And on those ARB models for the Baltics, the internal risk models, that whole overhaul process is going to plan working with the ECB.
They're holding extra capital just in case.
Yeah, proactively holding an estimated 16.5 billion krona in extra RWA just to cover any potential differences during the transition. Seems prudent. Approvals for the Swedish models are expected this year and next.
Right, let's zoom out a bit. The wider economic picture, the investor context, still quite uncertain globally.
Definitely. Geopolitics, trade tensions, it's all still rumbling on. We saw the ECB and the Riksbank cut rates this quarter, but the Fed held steady.
And the picture in Swedbank's home markets is a bit mixed.
A little bit, yeah. Lithuania's economy looked strong, but Estonia, Latvia, and Sweden were weaker. Sweden's government even cut its growth forecast for this year in half.
Ouch. But looking further out, maybe 2026, the outlook is better for them.
That's the projection. Swedbank's 4 home markets are expected to grow faster than the Eurozone and the U.S. in 2026.
Why is that?
Strong public finances, low government debt, real wages starting to grow again, and those lower interest rates eventually kicking in to boost activity. It's a potential advantage for them.
And this all feeds into their strategic plan, the 1527 plan.
Absolutely. That plan targets a sustainable ROE of at least 15% and a cost-to-income ratio below 0.4. It's all about boosting customer interaction, growing volumes sensibly, and just being more efficient.
And we saw some specifics on where they're focusing.
We did. In Sweden, it's about availability, deepening relationships, premium and private banking aiming to grow, corporate and institutions looking to expand, especially in real estate, manufacturing, SMEs.
And new areas like energy transition, defense, food production.
Yeah, setting up specific client teams there seems smart. And in the Baltics, it's about encouraging savings and holding on to their leading market positions.
Okay, but there's a potential spanner in the works, isn't there? The regulatory side, particularly bank taxes.
Ah, yes, a major point of discussion on the call. Management sounded quite concerned. They talked about sector-specific taxes, retroactive rules, unpredictable environments, basically asking for a level playing field.
Where are the main issues?
Well, Estonia is raising general corporate tax. Lithuania already has higher corporate tax, plus an extra 5% bank tax since 2020, and a new tax on net interest income.
But new lending is excluded from that one in Lithuania.
Yes, that's key. New lending is excluded there. But in Latvia, they're bringing in a similar NII tax for 3 years. But, and this is the crucial difference, new lending is not excluded.
Oof. So it directly hits banks for making new loans.
Exactly. Swedbank thinks this will hurt the Latvian economy, and they've actually filed a legal complaint about it. This specific Latvian tax is clearly impacting their strategy there already and will continue to. Definitely something for you to watch.
Right, we've covered a huge amount there on Swedbank's quarter and their strategy. Before we finish up, we always like to throw out a bit of a thought experiment, but obviously the usual disclaimer applies.
Absolutely. Please remember, everything we've discussed here is just for informational purposes.
Yeah.
It is definitely not financial advice. Always, always do your own homework or talk to a qualified financial advisor before making any investment choices.
Okay, disclaimer done. So, given everything we've heard, Swedbank's strengths, but also these specific Baltic tax headaches, what's an outrageous but plausible trade idea?
Well, how about this for a paired trade? Go long Swedbank, but at the same time, take a short position in a smaller regional Baltic bank, one that doesn't have Swedbank scale, diversification, or those hefty capital buffers we talked about.
Okay, break that down. The long Swedbank part seems pretty straightforward based on our discussion.
I think so. You've got the strong capital, that 19.7% CET1, the big buffer, disciplined costs, plus that nice tailwind from the VAT recoveries. Temporary investments rolling off. They're managing the rate situation proactively, investing in digital like Stabelo. The Era B model stuff seems under control too. It feels like a resilient story.
And the short side, targeting weaker Baltic players.
Exactly. Those specific bank taxes are the key here, especially in Latvia, where hitting new lending is quite punitive. For a smaller bank, maybe less diversified, without Swedbank's deep capital pockets or broad income streams.
These taxes could be a much bigger problem.
Potentially a structural disproportionate headwind, yeah. It could really squeeze their profits and force tough choices, making them vulnerable to underperforming compared to a big established player like Swedbank that can probably navigate it better.
Makes sense as a relative value idea. Okay, let's recap them.
Swedbank put in a strong Q2. They're handling a tricky economic backdrop through tight cost control, smart digital investments like Stabelo, and leveraging that very solid capital base.
Yeah, the focus on core banking, growing corporate loans especially, seems key. But they do face headwinds from falling rates, and particularly those targeted bank taxes in the Baltics.
Hopefully this deep dive has given you a solid grasp of Swedbank's performance and where they might be heading.
So what really stands out to you after hearing all this? Maybe think about those regional bank taxes. How might they really reshape the competitive landscape in the Nordic and Baltic banking world long term?
Could it push smaller banks towards consolidation or just mean ongoing pressure for them? Definitely something to mull over as you connect the dots yourself.